The relationship between risk and return is that risk and return are highly positively correlated. What this means is you cannot increase your return with taking more risk. And the way that we often hear this concept expressed, you'll hear people say high risk, high return, low risk, low return. So I think we probably have all heard that many times, but may not have spent a lot of time thinking about what does that really mean? What are the consequences of this correlation? And the consequences of the correlation are actually a little different, quite different, depending on which side of the equation you're looking at. So when I say high risk, high return, what does that mean? It doesn't mean that if I take high risk, I'm going to receive high return. Obviously, because high risk of return means volatility, high volatility of return, which means that if I take high risk, I may receive high return. I may receive low return. I may receive medium return or no return. So that's what the high risk, high return side of this equation looks like. On the low risk, low return side, it's very different. So when I say, if I take low risk, I will receive low return, that's what it means. Low risk equals low return. Why? Because low risk means low volatility of return. It means that the outcomes are going to be very consistent every time. If I take low risk, I'm not going to receive high return. I'm not going to receive medium return. I'm probably also not going to receive no return, because that's what low risk means. The way I like to think about it is if you put on a graph, the low risk is going to look like a horizontal line, essentially a horizontal line. The very little volatility in these returns. If we take high risk, the return is going to look like a zigzag, up and down, up and down, up and down, with big swings, because that's what high risk means. So how to summarize? Basically, if you take low risk, you're going to receive low return for sure, or for all practical intents and purposes, for sure. If you take high risk, you don't know what type of return you're going to receive, but one of the possibilities is high return. So the other way to think about that is, if you're seeking high return, you must take high risk. There's no way to generate high return by taking low risk. So it's an important thing to think about. How much return do you want? If you want high return, then you have to take high risk. If you're only willing to take low risk, you need to be satisfied with low return. So why does it work like this? Why is it that I can't take low risk and receive high return? Or why is it that I need to take high risk in order to have the potential to get high return? It's because return is essentially a price. It's a price of capital. Return to investors is paid by, for example, in company investment, which is what we're focusing on in entrepreneurship, return to investors is paid by companies. And the return that the investor receives is basically the price that the company is willing to pay for the capital that they receive. And in a market, in any market, price is determined by supply and demand. And therefore, the final price will always be the price that sets supply and demand in equilibrium. And in investment market, the price that sets supply and demand in equilibrium is always going to be the price where the risk equals the return. So why is that? Imagine you're looking at, let's do we'll do a thought experiment to illustrate this concept, because this is a really important concept for entrepreneurs or people considering becoming entrepreneurs. Imagine there's a market with companies seeking investment, and they're investors looking to invest in these companies. Further, imagine that all of the risk and return for each company in this market are known to all participants, both investors and companies. So further, imagine that not only are these risk and return of each company known, but they can be precisely measured. So for example, every company in the market has a risk score ranging from 1 to 10, where 1 is low and 10 is high. And all investors agree that this is an accurate assessment of the risk of investing in that company. And every company then pays a return somewhere between 1 and 10. Now, how is this market gonna look? Every company is going to pay a return exactly equal to its risk. Why? Let's say, take an example, a company that's risk level 5. What return are they going to pay? Are they going to pay risk? Are they going to pay return 6? No, they're not going to pay return 6. Why? They don't want to pay return 6 because now they're paying a return that's higher than their risk. This is costly for them. This means they are overpaying. This, you can imagine if you, let's say you walk into a store to buy something, and the thing that you want to buy is priced at $5. So do you ever offer to pay 6? No, nobody ever does that. Because why? If you could buy it for $5, why would you ever pay 6? You might try to buy for 4, but you're not going to try to pay 6. So that's why companies will never want to pay more than they need to pay to get investment. On the other side of this market, investors will never accept a return that is incommensurate with the risk that they're taking. So again, this company is risk level 5. If they are paying return 4, investors will never invest in this company. Why? Because why should they pay 5 to get 4 when every other company that they can buy for 5 is paying 5? So ultimately, you can see the supply and demand of capital in this market is always going to result in company risk level 5 paying return 5, with one exception. When might a company of risk level 5 pay return 6? I mentioned earlier that they don't want to do that because they're overpaying, but which is true in normal situations. But every once in a while, they might want to pay 6. Why? Because they need capital. They're, in effect, they're desperate for capital. So they're willing to pay more than they normally would need to pay to quickly attract capital. But this also will not break the relationship between risk and return in the long run. Why? Because they will do this for how long? They're only going to do this until their short-term need for capital is satisfied, because nobody wants to overpay in the long run. And how quickly will their short-term need for capital be satisfied should be very fast. Because why? If as soon as investors in this market see that a company of risk level 5 is paying return 6, what's going to happen? Investment is going to all flow to that company. Investors will all want to invest in that company because risk level 5, paying return 6. So supply will shift to that company. Their short-term demand will be satisfied, and their return will go back down to 5. So this is the market mechanism that enforces this relationship between risk and return. Now, why is this so important? And why do I start off our whole program with talking about risk and return in relation to entrepreneurship? The reason is now you should understand what's your role. What's your role in this process? You want to become an entrepreneur. Ultimately, you want investors to invest in your startup. So what are you selling those investors? You're not selling your product to investors. You're selling product to customers. What are you selling to investors? To investors, you're selling risk. Investors put money in your company because they want to buy risk. And how much risk do they want to buy? They want to buy the maximum amount of risk. And this has some very unusual consequences for the way that we think about risk as an entrepreneur and investor. So, for example, before we started our discussion this morning, if I asked you, what about risk? Is it good or bad? You probably would have said it's bad. Most of us don't like risk, don't want to take risk, try to manage risk, minimize risk. And that's very sound in most cases, most circumstances. But you can't take that thinking into your entrepreneurial ventures. So to illustrate how this works in real life. Now, imagine you are an entrepreneur and you're looking at potential investment in 2 startup companies. So let's say one company, the entrepreneur says, I have a really exciting business idea and it's very low risk. In fact, my startup is almost guaranteed to succeed. Let's say that's company 1. And then you have company 2. The entrepreneur says, I have a really exciting new product idea, but it's very highly risky and my company is almost guaranteed to fail. So now you have a choice, 2 investment. Company 1, almost guaranteed to succeed. Company 2, almost guaranteed to fail. So which one do you want to invest in? I'm pretty sure that your gut reaction or your intuitive reaction is, let's invest in company 1 because it's going to very likely succeed. This is wrong. The investor will always invest in company 2 and only company 2. Because why? Because it's almost guaranteed to fail. Now, what does that mean? That means that in the small number of cases where it does succeed, it's going to pay very high return. The company that is almost guaranteed to succeed, if it does succeed, it's not going to pay a high return. And therefore, it's not interesting for venture capital investors. So I'm pretty sure that unless we're already entrepreneurs or already venture capital investors, this is not how we have been thinking about risk up until now, but that's how we want to start thinking about it from now if we hope to create a successful startup. We're providing the highest possible risk investment opportunities for investors who are seeking the highest possible returns. And that's your job as startup entrepreneur. Now, by the way, I'll stop here for a minute and say, I will leave some time. I'll leave some time at the end of today's session for you to ask questions about anything that I said. You can also type questions into the chat at any time. So if you want to type questions into the chat while I'm talking, please go ahead. And if I have time, I'll answer those questions during the talk. And if not, I will start with those questions in the Q&A first. And you can type your questions into the chat in English or in Vietnamese, whatever you prefer. And if you type in Vietnamese, then it'll be translated and then I'll answer the question. So don't be shy to ask questions. Okay, so now we understand about risk and return. Now, who are the players in venture capital and startup ecosystem? On the one side are the entrepreneurs. On the other side are the venture investors. There are two types of entrepreneurs. I call these two types of entrepreneurs lifestyle entrepreneurs and high growth entrepreneurs. Lifestyle entrepreneurs can also be called, you might have heard them called SMEs, small medium enterprise. High growth entrepreneurs, you have also probably heard them called startups. So SME and startup, lifestyle entrepreneur and high growth entrepreneur. Now, in the world in general, and in Vietnam specific, there are many, many, many more lifestyle entrepreneurs than high growth entrepreneurs. In fact, I think Vietnam has one of the highest percentages of people in the economy who are, I would call in this definition, lifestyle entrepreneurs. What does that mean? These are people who, instead of being employed by a company or an organization, their main source of income is selling something, their own business. And this can be very small business, like they're selling some food products in the local market every day. They source the products and they sell them, and that's their main source of income. That's a lifestyle entrepreneur. Lifestyle entrepreneurs can also be big family-owned businesses, where they're still generating mostly income for themselves. And the characteristic of lifestyle or entrepreneur or SME is limited scope, complication, and slow growth, and strong emphasis on profitability. Because why? If you start a business to pay yourself, you better make some profit because you get paid out of the profit. High growth entrepreneurs are very rare, and not just in Vietnam, everywhere. Even in the US, which is the biggest startup market in the world, most entrepreneurs are not startups. The vast majority of entrepreneurs are SMEs or lifestyle entrepreneurs. Well, what is a startup entrepreneur? A startup entrepreneur is an entrepreneur that starts a business that is designed to grow big fast, and less emphasis on short-term profitability and much more emphasis on revenue growth, sales growth. So in our course, we're going to focus on high growth entrepreneurship, meaning how to create a business that grows big fast. We're not going to focus on small business entrepreneurship or what I call lifestyle entrepreneurship. So especially if you're a tech entrepreneur, med tech entrepreneur, life sciences entrepreneur, you're not going to be looking at SME. Most likely you won't be looking at an SME route for your business. You'll be looking at the startup route. So who are the investors on the other side of the table in the enterprise ecosystem? Banks and government. Banks and government are important players in startup finance. Government especially often funds startups through different types of programs, including direct investment, matching investment, grants, matching grants, etc. So banks are not as involved in startups at our stage. Some banks might have programs to help startups. Oftentimes, if they do, those programs are supported by government. Corporate VCs and investors. So corporate VCs, VC means venture capitalist. I'm going to talk a lot about that in my sessions in this program because I'm the VC, and coming from the VC perspective, when I talk about investing in startups. Corporate VCs and investors are different from traditional or financial VCs in the sense that they are the part of a company that whose main business is not venture capital investing. So many corporates have a venture capital arm, or they have an investment arm that makes investments in companies, including startup companies. These are very important players in the venture capital markets, and increasingly important over the last few years, and especially in Southeast Asia. Some of the most active investors are corporate VCs. So it's really important to know who are the corporate VCs that might be interested in your company, and to also understand the incentive for corporate VCs, which are different from financial VCs, because corporate VCs have a strategic investment goal as well as financial investment goal. Next, angel investors. Angel investors are individuals who invest their own money into startup companies, and especially early stage companies. So angel investors are really important constituency for early stage startups. And angel investors are a very diverse group. They range from investors who are very similar in their approach to venture capital investors, to individuals with very little experience in investing in startups. So angel investors are a very valuable resource for startup companies. The thing I like to mention early about angel investors is because of the variation in the experience and the skill set of angel investors, it's really important to do your due diligence on angel investors. It's important to do due diligence on all types of investors, but especially angel investors, because you don't really know whether a particular angel investor knows what they're doing or not. And also angel investors can have strategic goals, just like corporate VCs. These often differ from the corporate VC strategic goals, but angel investors can have non-financial reasons for investing in startup companies. Like, for example, they want to help out entrepreneurs, they want to be involved in the ecosystem, they want to give back to the community, etc. Next is seed investors, incubators, and accelerators. So seed investors, incubators, and accelerators are organizations that are set up specifically to take in to help startup companies at the early stage and also invest in those companies. So our partner in this program, Sci-Hub, is an incubator, accelerator, seed investor in Vietnam. And these are especially important players to know because their whole mission and focus is investing in early stage startups. They're going to be generally, and especially if they're a credible partner like Sci-Hub, they will be professional investors that know how to help startups, and we call this smart money. And of course, last but not least, venture capital investors. So venture capital investors are investment funds that are set up solely to invest in startup companies. The fund managers raise money from investors who are looking to, as we talked about earlier, generate very high returns on their investment. And the investment manager then invests in a diversified portfolio of startup companies in an attempt to generate optimized risk return portfolio for their investors. So what's important to remember about venture capital investors is, unlike angel investors, venture capital investors are usually pretty consistent quality. They're not all great, but of course the average is still going to be average quality, but they'll be average quality for VCs, which means they're going to be significantly higher than pretty much all the other participants in our ecosystem. Because why? Because they're investing money from investors who are entrusting them to generate returns for them. This means that if they're not skilled, or not professional, or they don't know what they're doing, they typically won't persist in the market for that long, because they're also subject to the laws of supply and demand that we talked about before. And other thing to note about venture capital investors, because they're competing in the market for fund investors, they're going to have pretty similar terms, and they're going to have pretty similar focus. They're going to focus exclusively on financial return, unless they're very specialized funds. And the terms that they're going to offer to startups are also going to be pretty consistent, because as we'll see later, the terms that investors offer startups are a very important component of the venture capital investors' return strategy. Okay, so those are the types of investors that you should think about as a startup. And we'll talk about the types of investors later in the program, and especially when we get to the investment section. But I wanted to introduce the key players at this stage, so you understand where are you in the ecosystem, and who are the other players that are going to be important to you on this journey. So these are the relative roles that they play. Entrepreneurs are creating the opportunities, raising money, managing the finances, increasing the value of their company, and generating returns for investors. Venture investors are identifying those opportunities, selecting the best among them, providing funding to the entrepreneurs, helping the entrepreneurs to manage their finances, and assisting them with the growth of their company, and ultimately generating returns for themselves or their investors, depending on whether they're an angel or a VC. So entrepreneurs are people who start businesses. And I think it's interesting to note that in the history of entrepreneurship, and if you think about the derivation of the word entrepreneur, it originally refers to people who are starting enterprises, which are similar to the scalable businesses that I mentioned earlier. So in fact, the earliest definitions of the word entrepreneur linked entrepreneurs with enterprise creation. We talked about this already. So the main differences between small business and scalable business are the growth trajectory and the risk. So small business is designed to grow profitably over long periods of time. Scalable business is designed to grow big fast. And since I am going to talk about the grow big fast many times during our program, and because the grow big fast strategy is going to be so important for what you're going to be learning in our program, I think it's useful if I give you some numbers around grow big fast so you have a sense for what does that mean. Now, like most of the numbers in what we do venture capital, the numbers for grow big fast are not set in stone. They're benchmark numbers, and a little more, a little less is expected. So when I say grow big fast, the first quantity in that sentence is big. So as a startup entrepreneur, you're trying to grow your company big. So what does that mean? Grow big how? Grow big in terms of what? In order to measure a company's size, we would need a metric along which to measure that company. So what dimension of the company should I measure to decide if it's big or not? There are lots of reasonable options that we can choose, but the one that I like to focus on is the company value. Why company value? Because unlike other metrics, company value is comparable across all companies. For example, if we pick another metric to measure companies by, to decide which one is big, which one is small. For example, number of customers, which is bigger, a company with 10 customers or 1 million customers? Actually, we don't really know because it depends on how much those customers spend. If the company with 10 customers, if each one spends $1 million, then they're getting 10 million in revenue. If the company with 1 million customers, each one spends $1, then they only got 1 million in revenue. So actually, on a revenue basis, the company with 10 customers might be 10 times the size of the company with 1 million customers. So we can never really know which company is big and which is small, or comparatively which company is bigger if we look at something like customer numbers. Revenue also may not tell us, because revenue may be less informative about the size of the company when if we're looking, for example, at profit margin. But firm value, so company value is directly comparable. So if one company is worth $10 million, another company is worth $100 million, that company that's worth $100 million is 10 times bigger than the company that's worth $10 million. So when we talk about growing big, we will refer to the size, the level of the company's value, or the absolute value of the company. Now, okay, so that's our metric. What do we need to achieve in that metric in order to be considered big? Because big is a little vague. So I like to set a threshold for the company to be considered big at a value of 100 million US dollars. So if the company is worth 100 million US dollars, we're going to consider it big. 100 million US dollars is about 2.3 trillion Vietnamese dong. So 2 followed by 12 zeros. So that's a lot of money. I think no matter how you cut it. We hear a lot about unicorns. Unicorns are companies that are valued at $1 billion, which is 10 times my threshold for big. So, which I think is good news for us. I don't think the unicorn threshold is as meaningful as the big threshold. Because why? You don't really need to be a unicorn to be a successful startup. If you can reach a value of 100 million US dollars, you are already a successful startup. Of course, if you get to unicorn, it's great, but it's not necessary. So firm value 100 million, and you're considered big. Now, again, it's not a magic number. If you're 90, it's not like 99 million, you're small, and 100 million, you're suddenly big. But it's a good benchmark. 20 million, you're not really big. 90 million, you're big. So we'll target to get to somewhere around 100 million. And when I say fast, so we want to grow big fast. So how fast is fast? Our company, let's assume our company is worth 1 to 2 million today, which is not unusual value for a very early stage startup, probably like the one that you would be either have already started or considering starting. So 1 to 2 million today, you need to reach the $100 million value when, in order for this journey to be considered fast. So there, I like to set a time frame of 5 to 10 years. So this is your goal as startup entrepreneur, to reach a value for your company of 100 million US dollars within 5 to 10 years. And why that's important is, in order to get investment from venture capital investors, you're going to need to have a strategy and a plan that enables you to do that. So how are you going to do that? It's actually pretty straightforward. To create a successful startup company, you need a team, an idea, a business plan, and you need to raise money from investors. So sometimes people start a team, then come up with an idea. Sometimes people or a person has an idea, they form a team around that idea, write a business plan, create an investment pitch, and raise money. And this is the process that we're going to try to help you to execute in our program over the next several weeks. So you will be learning how to identify idea, or if you already have an idea, how to develop that idea into a product, and then how to build a business plan around that, how to present that plan to investors and raise money for that business. So actually, you can see the steps are pretty straightforward. It's not that difficult to do, meaning it's not that difficult to execute the steps that are required to become a successful startup. However, it is really difficult to successfully, execute each of the steps. So it's a simple process, but it's very challenging to execute. And after you finish our program, you should be better able to execute that than you would have been if you tried to do on your own. What are some of the qualities that make successful entrepreneurs? Successful entrepreneurs are intelligent. They have creative problem-solving skills. They're self-started, committed, motivated, and risk-taking. So this might be a good time for you to think about where are you on a spectrum for each of these qualities. These qualities are not binary. It's not like people are committed, uncommitted. Each person will have different, varying degrees of commitment. So some people are average, some people are less committed, some people are super committed. Where are you on that spectrum? if you want to be a successful entrepreneur, you need to be, or it's going to be a lot easier for you if you're on the spectrum of these qualities toward the high side. So highly intelligent, better creative problem solving skills, more self-starting, etc. Meaning it's even people that are that have high degrees of each of these qualities and do a startup. Most startups fail, which we're going to talk about in a minute. But entrepreneurs that are lacking one or more of these qualities, or that have these qualities to a very low degree, are going to find almost impossible to succeed. You know, it's like, in some ways, I think a very good analogy for successful entrepreneurship, it's like professional sports. You know, if you want to be successful in professional sports, you need to be at the top of your game. You need to be one of the top players in your field, and you need to be constantly training. And then you need to be executing perfectly. So let's say you decide you're going to get involved in professional sports, but you're amateur, you don't have a skill set, you're not dedicated, you don't work hard. I mean, not only are you going to fail, but you're going to fail, miserably. And the same thing for entrepreneurs. So this is it's a game for serious players who are willing to do what it takes to succeed. And if that's you, great. If it's not you, then I would think about doing something else with your time, because ultimately it's not going to be rewarding for you. Now, entrepreneurship, it's a great thing to do for yourself, but it's also a great thing to do for your country. And if you look at the relationship between a thriving entrepreneurial sector and GDP growth, productivity growth in a particular economy, you see very high correlation. So companies founded by innovative entrepreneurs account for over 50% of productivity growth in economies with thriving entrepreneurial sectors. So what is the relationship between this and you is, when you create a successful startup company, you don't just do something good for yourself and your investors, you do something good for your country and potentially the world, because you create products that and services that improve the lives of people, and especially in the biotech or biomedical space. I think one of the things that we've seen over the last 18 months is how important a role new products and services can play in quality of life in the world. And just think about what has been our experience of this pandemic. Think about the products and services that have helped us to fight the pandemic, from the protective devices to the treatments to the vaccines. All of these were created by people, companies, entrepreneurs, with help of government, and potentially saving millions of lives. And you can be a part of that as a successful entrepreneur. Of course, we've had a terrible exogenous circumstance over the last 18 months, but even when we're not in the midst of terrible pandemics like this, new entrepreneurs and new companies change the world. And if that's something interesting or important to you, you have a great opportunity to do that. So at a personal level, you can think about, I like to ask entrepreneurs to think about, or people considering entrepreneurship to think about, what type of life do they want to have? Average or extraordinary? And what do they want to do with their lives? Do they want to create something of value from nothing, or just try to make money? Do you want to make a difference? Do you want to change the world in some way? Do you want to leave something of value after you're gone? You can do all of these things as successful entrepreneur. You will have extraordinary life. You can create something of value from nothing. you can become rich. No guarantee. And in fact, most entrepreneurs don't become rich, but the most successful entrepreneurs will become the richest people in the world. You can do something meaningful with your life while you're making a difference, changing the world, and leaving something of value behind after you're gone. There are very few activities that you can do in your life that have these benefits. And if these are important goals for you, then entrepreneurship is a great way to try to achieve these goals. Now, entrepreneurship sounds great. You can do great things for yourself. You can do great things for your country. You can do great things for the world. So why doesn't everybody just do it? There are a couple of reasons why, and starting with lack of entrepreneurial skills. This is a great thing to do. Create a scalable business is a great thing to do, but it's not easy. And nobody has the skills that they need to do this without training. Nobody's born to become a successful, scalable entrepreneur. So lack of skills stops a lot of people from going down this road. The good news is this is fixable. You can develop these skills, and we're going to help you develop some of these skills, or as many of these skills as possible, during our time together in our training program. Attitude toward risk. I spent a lot of time at the beginning of this morning session talking about attitude toward risk, and you might have wondered about why. The reason is this is one of the primary obstacles that stops people from becoming successful, scalable entrepreneurs. They don't understand risk in the same way as investors do, and therefore they have no chance of creating a successful startup. So good news about attitude toward risk, it can be improved. And again, we're going to try to help you improve your attitude toward risk in our program. So-called third obstacle, so-called cultural attitudes toward failure. And especially in Asia and Southeast Asia, a lot of people believe that a different attitude toward failure from for example, from attitudes toward failure in the US or maybe Europe is an impediment to entrepreneurship. I don't really see this myself. I think I don't believe in cultural attitudes, because cultures can't have attitudes, only people can have attitudes. And this so-called cultural attitudes, to me, is just an average of the attitudes of the people in a particular culture, which means that they can change. And I think cultural attitudes toward failure in Southeast Asia have changed markedly over my 21 years here, and have changed in a direction favorable for entrepreneurs, meaning business failure is much more widely accepted now than it was 20 years ago. And I believe that that is part of a long-term trend. So this is going to become less and less of an issue, if it is even an issue today. And last obstacle to entrepreneurial success is that entrepreneurial success is difficult, and most startups fail. And that's something that's a theme I'm going to come back to many times in our program, because that's really important to A, understand, and B, to internalize, and C, to understand why that's good. And this is the first point I'll make about, I'll make the point the first time here. The fact that entrepreneurial success is difficult is a good thing, not a bad thing. Actually, it's second time, because I mentioned this in the risk and return discussion. If entrepreneurial success was easy, then it wouldn't be meaningful. It wouldn't generate meaningful results. Only doing difficult things generates meaningful results. It's another version or variation of our risk and return correlation. So difficulty and meaning are also very highly correlated. If we succeed at doing something easy, this does not generate a meaningful result because it's easy to achieve. When we succeed at doing something difficult, we then generate meaningful results because that's where meaning comes from. Meaning comes from doing something difficult to achieve. And that's why it's valuable. So entrepreneurial success is difficult. We don't want to change that. We're not going to try to make it easier. What are we going to try to do in our course? We're going to try to increase the probability that you're going to succeed. It's difficult to succeed in entrepreneurship means that most people fail. And I have there are a couple of different ways of calculating this. I'll show some numbers in a minute, but let's just start with 3%. So 3% is my percentage, the number that I like to use for percentage of scalable entrepreneurs that actually meet the target that I talked about before, which is getting to this 100 million in firm value. So let's assume that that number is around 3%. Now, whatever we learn in our course, it's not going to change that. And it shouldn't change that because we want that 3% to stay stable. What we'll try to do is to improve your chances of being in that 3%. Right now, everybody has a random chance of being in that 3%. After you complete the course, you should have a higher probability of being in that 3%. So we haven't made entrepreneurial success less difficult, but we have made it more likely that you're going to be one of the success cases. I have mentioned that entrepreneurial ecosystem consists of investors and startups. And I talked about the two types of new companies, lifestyle and startup, but I haven't really explained why why would you pursue one of the two routes over the other, and also why investors only focus on the startup, not the SME. So let's look at that in a little more detail now. Why should startups raise money? The reason startups should raise money is there are two outcomes for your new company. It can become a small pie or a big pie, meaning you can start a SME, you can grow slowly over a long period of time, and let's say 10 years from now, you're still going to be small. Or you can begin a startup and you can attempt to grow big fast, and 10 years from now, you'll either be big or you'll be gone. So if you want a big pie, then you need to choose startup route. And in order to create a big pie, you're going to need to raise money. You will also need to share that pie with investors, because the most common way that you raise money for your startup is by selling shares in your business. So if you don't want to become big, you're satisfied with staying small, then you don't need to raise money and you don't need to give up shares in your business. So I like everybody to think about, as they embark on their entrepreneurial career, what do I want? Do I want a big piece of a small pie or a small piece of a big pie? Neither of those choices is right or wrong, but they're different. And you have to be clear about what you're trying to do. Do I want to create a big company that I will own a small piece of, or do I want to create a small company that I can own a big piece or all of? Don't get stuck in the middle. I see some unrealistic new entrepreneurs. They want to start a big company, but they want to keep all the money for themselves. It doesn't work like that. Later, we'll talk about why, but for now, just enough to know it doesn't work like that. How do investors make money? So investors make money two ways: trade sale or IPO. So assuming that you choose the startup route, you choose to grow your business big fast, and you raise money to do that. And in most cases, you're going to raise that money by selling shares in your business. So now the investor has shares in your business. And if they're a venture capital investor, how do they make money? They don't make money through dividends or royalties like some angel investors do. They make money through exits. And that means they get to sell all of their shares in a trade sale, or they sell all of their shares in an IPO. Trade sale means your startup is sold to another company, a much larger company who buys the whole company. An IPO means your startup is listed on a public exchange. In either case, the investors get to sell their shares. And that's called exit. That's how VCs make money. So what's the important consequence of this for you? If you want to become a scalable entrepreneur and you want to raise money from venture capital investors, this means you need to have an exit strategy, which means you need to plan to sell the company to either a much larger company or to list it in an IPO within the next 5 to 10 years. Now, I mentioned that most startups fail, and now I want to drill down on that in a little more detail. This is a distribution of returns for two types of investment funds. The normal distribution, which you see in the center, shaped like a bell, is the distribution of returns for a typical investment fund. The second distribution, which is labeled power law distribution, is the way that startup portfolio for venture capital investors drive returns. So in the normal distribution, so let's say I'm doing a unit trust or a typical mutual fund. I'm investing in a diversified portfolio of publicly traded companies. So if I graph my returns on a portfolio, it's going to look like this bell curve. What does it mean? It means most of my investments will deliver the mean return, the average return. And 2/3 of my investments will deliver a return plus or minus 1 standard deviation from the mean return, and 95% of my portfolio will deliver a return plus or minus 2 standard deviations of my mean portfolio return. And everybody, since you're all scientists or researcher or involved with technical products, you'll understand normal distribution. We see this in many phenomena, not just investment portfolios. But this is not how venture capital fund returns are distributed. They're not distributed in a bell curve. They're distributed according to a power law. And what does that mean? This means that in a typical venture capital fund portfolio, a very small percentage of the investment drive most of the returns. That's what this steep curve shows us. So what does that look like in numbers? If you look at a typical venture capital fund portfolio, this is the distribution of returns 10 years after investment. So this is for early stage investment portfolio. It's actually not first non-seed, so it'll be a little later than investment in most of your companies. 10 years later, what do the returns look like? It looks like this. Approximately 50% of the investments have gone to zero, meaning total write-off. If the investor invested $1 million in your company, they got back zero. So they're minus $1 million. That's also important to note. Zero return in venture capital does not mean no increase in value of the original investment. It doesn't mean you invested $1 million, you got $1 million back 5 years later with zero return. Zero means you're minus the investment. That's the expected outcome for about half of the portfolio. Another 25% of the portfolio will be less than 1 time. Less than 1 time is what's usually considered zero return. So less than 1 time means we invested $1 million and we got back less than $1 million. So actually meaning we didn't, not only did we not achieve any additional return, but we lost a percentage of the principal. And this happens about 25% of the time. And I think calling it less than 1 time, it's accurate, but it can be a little misleading because what? Let's say, again, the investor put in $1 million and they got back $20,000. So what is that classified as? Less than 1 time, but it's way less than 1 time. It's almost indistinguishable from zero, and a lot of less than, I believe, a lot of less than 1 time venture capital investment returns look like that. So to be conservative, I lump those two together and say approximately 75% of your venture capital investments fail to return capital, meaning deliver either zero or less than 1 time. So we can effectively write off 75% of our portfolio as going to fail. And of the 25% that do succeed, only 3% generate 20 times or more. And in venture capital math, which we're going to go through in more detail later in the program, we're going to need basically more than 20 time return in order to achieve our cost of capital. And you can see that return is driven by only 3% of the typical portfolio, which is why I introduced this 3% concept in the previous discussion. So what's your goal as an entrepreneur is to be in this 25% and especially to be in this 3%. Now, I think when you see the portfolio results illustrated like this, now you should really understand, what does high risk mean? High risk means my return distribution looks like this. And I don't think there's any other form of investment or traditional form of investment where 75% of the portfolio fails to return capital. And this is what the returns look like if we graph in a similar shape to our distribution that we showed, but here you can see how the very small percentage of the investments are delivering those very high returns. So what type of companies generate these high returns? This is a graphic that helps to illustrate the answer to that question. If you look at the names of the companies in this graphic and think about the question, in what way are all these companies the same as one another, yet different from other companies? So what is the unifying characteristic of these companies that makes them all similar to each other, but different from other companies? And at first glance, you might think tech companies, they're all tech companies. Actually, this is close, but not correct, because there are a lot of tech companies in this graphic, but not all the companies are tech. For example, Starbucks is not tech. Staples, which is a hardware store chain in the US, is not tech. Staples, which is an office supply chain in the US, is not tech. Home Depot, which is hardware store chain, not tech. But most of the other companies are tech. But let's look at, in what way are all the companies the same? They're all the same because they are or were at one time the number one company in their product category in their market. So that's the type of company that generates the required return for venture capital fund investors. Companies that have the potential to become number one in their product category in their market within 5 to 10 years. And this is really important information for you as a potential scalable entrepreneur. So what do you need to be presenting to investors? At the very high level, you need to be presenting to investors that our company has the potential to become number one in our product category in our market within 5 to 10 years. So you can imagine your company name is added to this graphic. And what's special about these companies too, almost everybody knows these companies. Why do they know them? I mean, at least a lot of these companies. Why do people know them? Because people know the number one company in its product category in its market. Now, one commonality that connects all these companies, in addition to their number one in product category status, is most of these companies are from the US. Now, that's, I believe, a historical feature, not a systemic feature of this concept. Meaning what? I think 5 to 10 years from now, you're going to see many more non-US companies on this list. And in fact, this list was created 10 plus years ago. And we could create a new list today that would include a fair number of non-US companies. And what's your goal then as a Vietnam-based entrepreneur? Is first goal is to get on a chart like this for Vietnam market. So your company becomes number one in your product category in Vietnam, you're already success. ASEAN, also bigger success. Southeast Asia, bigger success. So good thing is, as a Vietnam-based entrepreneur or based in any country in Southeast Asia, you don't have to achieve number one in the world status to be successful. Of course, if you can become number one in the world, that's great, let's do it. But you can already be successful, number one in Vietnam, number one in ASEAN, number one in Southeast Asia, number one in 5 countries in Southeast Asia. So let's have that in mind as our big picture target. We're going to become number one in our product category in our geographical market. What industry verticals do these companies get founded in? It's not all verticals. And in fact, the vast majority of venture funded companies are created in a very small number of verticals: healthcare, information technology, and clean technology. And it's no coincidence. Why are so many successful startups created in these verticals? It's because of the growth rate. So these are not necessarily the biggest industry sectors in the world. There are a lot of bigger sectors that are not represented here. We don't see manufacturing here. We don't see retail here. We don't see food and beverage here. All of which can be bigger than one or more of these segments. So what's special about these segments is that they have been the fastest growing, among the fastest growing segments in the global economy for the last 30 years, and some for the last 10 to 20 years. And the good news is, especially good news for us, I believe that all of us, all of the participants in our program are involved in one or the other of these areas. So if you're somebody with expertise in one of these areas, and especially if you're a researcher or a scientist or a technologist who has developed an idea in one of these areas that can be converted into a product that can become the core of a company, you are many steps ahead already of other potential entrepreneurs. Why is that? Because a lot of specialized knowledge is required for you to get to this stage. And that specialized knowledge is very difficult for average person to acquire. Um, I'm sure a lot of our participants have 10, 20 years already invested in developing their ideas, their research projects, or the areas that they're specializing in. And this is something that nobody or very few people are going to be able to copy. I always like to tell, especially scientific or researcher or technologist driven entrepreneurs, it's, let's say you have a PhD in your top research area. It's a lot easier for you to get an MBA at this point than for an MBA to get a PhD in your research area. They're going to have to put in, another 5 to 10 years. You can get your MBA in 12 to 24 months. So business skills are much easier and faster to acquire than technical skills. What about product versus service? So successful startups are mostly product driven or mostly service driven. There are two slightly surprising answers to this question. First of all, successful startups are almost all product driven and not service driven. And the second somewhat surprising answer to this question is, what do we as venture investors define as product? So product-based companies typically scale better than service-based because why? Because service-based companies rely on people to deliver their value proposition to customers. Product-based startups rely on technology or capital to deliver their value proposition to customers. To understand that concept, I think I use the example here of Google versus McDonald's. So Google seems like out of these two companies, if we're to say, which one is the product company, which one is the service company? If McDonald's sounds like it should be the product company because it's delivering burgers, it's selling burgers, which are a product to customers. Google sounds like it's a service company because it's providing search, which is a service. But in fact, in our definition of product versus service, it's reversed. Google is the product company because why? Because they're delivering search with computers, with technology. McDonald's is the service company because they're delivering burgers with people. In every McDonald's, there's many people working, or relatively many people working. So I think worldwide, McDonald's employs, including franchises, more than 1 million people. Google employs tens of thousands of people. So McDonald's, millions of people working, Google, tens of thousands of people. McDonald's delivers 1 billion burgers a year using millions of people. Google delivers billions of search results every hour with tens of thousands of people. That's why Google is a product company and more scalable. McDonald's is a service company and less scalable. To be a successful entrepreneur, we don't have to just have a product versus a service, and we don't have to just be operating in the right vertical, meaning one of the 3 verticals that we saw dominate the startup product scene, but we need to enter the market at the right time. So those are the 3 important first steps in becoming a successful scalable startup. 1, we have to have a product, not a service, and we have to have the right product. 2, we need to be in the right industry vertical. And 3, we need to enter the market at the right time. So when is the right time to enter the market? We can try to understand that by looking at this market technology adoption S-curve. Most markets develop along a S-curve over the lifetime of the market. What does that mean? The market goes through a long period of slow growth. It reaches an inflection point. It then grows exponentially for some period of time, and then market growth slows and a new product enters and begins a new S-curve. So if we want to be a successful startup, when should we enter the market? We want to enter the market before, ideally we would like to enter the market at the inflection point, meaning after the period of long period of slow growth has ended, just as the market is beginning to grow exponentially. So we can visualize the inflection point is somewhere above the I in the word time on the x-axis. If we enter at that point, we will benefit from maximum amount of exponential growth. But in fact, we can never enter at the optimal point. The probability that we will enter at the optimal point is 0. Why? There's only one optimal point, and there's an infinite number of points on our curve. Therefore, the probability of entering at the optimal point is 1 divided by infinite, which is 0. So that's actually good news, because it's good news because it frees us from focusing on entering at the optimal point. And it makes our market entry timing decision much simpler. Do we want to enter before or after the optimal point? And now the probability of doing that successfully is 50%, because when we bisect the curve into 2 segments, we just need to pick one, and we have a 50% chance of getting in at the right time. So I believe successful startups enter before the inflection point. Why? Because then you still have a chance to benefit from the exponential growth phase. If you enter after the optimal point, there's no way you're going to benefit from the full exponential growth, and guaranteed that you'll miss some of that. And if you entered way too late, you're definitely not going to get the benefit of that exponential growth. So the key is to enter before the inflection point, but not too far before, because if you enter too early, there's a very strong probability your company will die before the market inflects. Markets take a longer time to develop than we probably think they're going to. So we want to enter early, but not too early. And the example I like to use is, if you look at some markets like virtual reality market, the first virtual reality products hit the market in the 1990s. The market didn't reach an inflection point until 2016. So that's almost more than 20 years. In the lifetime of a startup, the vast majority of startups that entered before 2010 died. So think about not just the product versus service, think about not just the market segment that you're going to enter, the industry vertical, but think about market timing. So you want to be entering with a product in the right vertical at the right time, which means a market that has not yet reached its inflection point. Okay, so next thing I'm going to talk about is assessing product market fit. But because we have reached now 10 o'clock, so let's take a short break. We'll take now a 10-minute break, and then we'll resume at 10:10 to continue discussing product market fit. And don't forget to put any questions that you might have into the chat so that we can discuss those during the Q&A session. Okay, so we'll now have a 10-minute break, and I'll see you back here at 10:10 to discuss product market fit.
Thank you.
We will discuss the Q&A session at the end of today, right?
We'll have Q&A session at the end. We're going to now have a 10-minute break so people can go to the toilet or get something to eat. We'll be back in 10 minutes.
All right. Thank you.
Okay, welcome back, everybody. Hope you had a good break. All right, I'm going to continue now sharing the slides. Okay, I trust everybody can see the slides now. Going to talk about the key elements for success. Important to note, investors, I believe, tend to use this kind of a decision tree in evaluating investment ideas, which means that they will have some mental checklist of elements for success that constitute interesting startup investment. And when they evaluate a startup, they'll work through that list in some gated structure. And if the startup fails to pass through any of the gates, they just reject. I know I tend to do this, and most of the investors I know also tend to do this. Why is that? Because as an investor with many potential startup opportunities, it makes sense to over reject rather than over accept. Because why? Since most startups are going to fail anyway, the probability that we're rejecting a winning startup, the joint probability that we're rejecting a winning startup and that startup happens to be missing one of the key elements for success is vanishingly small. What does it mean? If you think about the 3% of successful startups all have the key elements for success, that's why they're key elements for success. And then we calculate the probability that a startup missing one or more of those key elements for success is going to make it into that 3%. Your probability becomes like a lottery ticket. So we don't want to buy lottery tickets. We want to invest in potentially successful startups. What are those key elements for success? This is the list that I use, and this is the list that all of our programs are structured around. So when we help train entrepreneurs to raise money, we help them to identify each of these in their business idea and to build out the pitch deck and the financial plan and the financial model so that they demonstrate that the startup does have these key elements for success, starting with innovation. And innovation is something new and useful. In every product category, there are three waves of entrepreneurs: the innovators, the imitators, and the idiots. The innovators are the companies that come early into the market. The imitators are the ones that copy the innovators, and the idiots are the ones that come too late for any startup to scale to the level that we need to be successful. So what are the innovators, and why is innovation so important for startup success? The innovators are startups that enter the market with an innovative product that solves a painful problem for customers. Now, this is an area where entrepreneurs that come from the research or university side or technology side have a built-in advantage over business model focused entrepreneurs because they all come with the potential for an innovation. If you're a researcher or a scientist and you're developing new knowledge in an area of your area of specialization, and if that new knowledge can ultimately be applied to a business problem or a product, then you have innovation. Now, innovation is important for several reasons. The first is that we talked about the inflection point in the market. Inflection point in the market almost always will correlate with an innovation. So your chances of getting into the right market at the right time as an innovator are much, much higher than as an imitator. And second reason is competitive advantage. We're going to talk about competitive advantage later in the program in its own section, but just to give a preview, I'll give a short preview of that today. But innovation is a really important weapon in generating competitive advantage because innovation can form the basis of intellectual property, proprietary intellectual property, which can be really critical for your competitive advantage. And also innovation helps you create barriers to entry for especially large players who struggle with innovation. So innovation is one area where startups tend to have a built-in advantage versus established players, where usually startups suffer significant disadvantage versus established players because established players have a lot of resources that startups don't have. So innovation is a playing field where startups can compete not just equally with large players, but maybe even with advantage. And the third benefit of innovation is in helping to solve the selection problem. So as an investor, I'm seeing many different potential startup ideas every day. And how do you stand out from other startups that are seeking investment? Because in order to get investment, first you have to stand out to investors. Innovation is one way to do that. So when a startup has an innovative product, it's going to attract the attention of investors a lot more quickly and effectively than a startup with a non-innovative product. So imagine you're an investor, entrepreneur, comes in and pitches you a brand new idea. It's something you never heard before, versus another entrepreneur who comes in and pitches you the 10th version of an idea that you've heard 9 other times in the last couple of weeks. So that entrepreneur who's 10th idea, the 10th version of the same idea is going to be much less likely to stand out than the entrepreneur that pitches you a new idea for the first time. So innovation benefits the startup in 3 ways: in helping you to stand out, in helping you to get into the right market at the right time, and in helping you to compete effectively in that market once you enter. But innovation by itself is not enough. If innovation by itself was enough to create a successful startup, then every entrepreneur with innovation would have a good chance to succeed, but that's not the case. The innovation by itself is not sufficient. We need innovation coupled with a value proposition. So value proposition means solving a painful problem for customers. In order for an innovation to be the basis of a successful product, the innovation must be applied to a successful, must be applied to a painful problem. Now, we have a special name for innovation that is not being applied to a painful problem. And this is very common. This is a very common phenomenon with especially researcher, scientist, or technologist driven startup ideas. When you have an innovation that's not solving a painful problem for customers, we call that a solution seeking a problem. And we might see that as we might encounter that as we try to help you develop your business plan. Your pitch deck is, are you currently a solution seeking a problem? That's not necessarily bad at this stage because we still have time to fix that. But by the time you get to investors and try to pitch for investment, you don't want to be a solution seeking a problem. You want to be an innovation with a strong value proposition, meaning you have an innovative product that solves a painful problem for customers. Now, why is that so important? That is so important because why do so many startups fail? I already introduced my portfolio success distribution so that we understand most startups are going to fail. But why do they fail? What's the most common reason that startups fail? The most common reason that startups fail is insufficient demand for their product, meaning the startup launches the product and ultimately it turns out there is insufficient demand for that product, therefore no revenue or insufficient revenue, therefore the startup dies. And it basically dies pretty quickly, which is a good thing if you're going to die. If you're a startup that's going to die, better to die quickly than long, slow, painful death. But lack of value proposition drives insufficient demand. Why? Why is it that there is so often insufficient demand for products, startup products? The reason there was insufficient demand is the product was not solving a painful problem for customers. And this is the biggest first mistake that entrepreneurs make. They're in love with their product. So they believe the product is great and they launch the product into the market without applying it to a painful problem or without identifying the painful problem that it's supposed to solve for customers. And it launches into the market to thundering silence and lack of demand, and the company dies. So now, what makes successful value proposition is when the product solves a painful problem. Why is that so important? Because what drives demand? What are the factors that drive demand, or what's the most important factor driving demand is pain. Because why? Because pain is the most powerful motivator of people in many dimensions, especially demand. How to understand that with some example. Why do people buy products, or which products do people buy first? People buy products first that solve painful problems for them. And we can almost be guaranteed that if we have a product that solves a painful problem, when we launch it in the market, there will be demand for that product. Now, I've been talking about this for many years, since I started teaching entrepreneurship and helping entrepreneurs, saying you have to solve a painful problem with your innovative product because pain drives demand. And have we, in the last 18 months, we have seen this lesson written large over and over again. Think about the shifts in demand that we saw for products, especially during the early days of the pandemic. And even today in countries where the pandemic is still at high levels. For example, what was the demand for N95 masks in 2019? Not much. What was the demand for hand sanitizer in 2019? Not much. What was the demand for COVID vaccines in 2019? Nothing. The product category didn't even exist. So every one of those products that I just mentioned became almost overnight the most demanded products in the world. You probably remember 2020, early 2020, you couldn't even buy hand sanitizer. You couldn't even buy N95 masks. There was a black market in N95 masks. Imagine, meaning the demand for N95 masks increased exponentially almost overnight, and the supply was nowhere near satisfying that. Why? Painful problem. A new painful problem entered the market, extremely painful, and this created a huge surge in demand. So we couldn't have learned this lesson more strongly if we set out to do it. It's a real experiment in the market with very clear results, pain driving demand. But it's not just during pandemics that this happens, and especially I think important for us. There's a type of company that can achieve the 100 million or even more firm value that I mentioned before with a very curious profile. So let me describe this type of company to you. See if you can guess what is the company's product. So the company is a startup, but it's not new. It's almost 10 years old already. The company is product driven. It's innovative, product driven, but the company has spent its entire lifetime just doing product development and testing. And they have never sold any product. They have never sold their product to customers. They have no revenue. They have raised tens of millions of venture capital dollars and invested it all in product development and testing. They will never generate any revenue, but the company will be sold tomorrow for $400 million. And the buyer is a much larger company in the same sector that knows everything that we just talked about relating to that company. So what is the company's product? The company's product is a new pharmaceutical drug. And the pharmaceutical drug has successfully completed several phases of FDA trials and been approved. So the company doesn't need to generate revenue. They don't need to sell the product. They just need to develop it, protect it with IP, and complete clinical trials so that it's proven to be safe and effective in humans. Now, why would that company achieve such a high valuation and be able to be sold without any of the traditional metrics that we use to value companies? No market traction, no revenue, no profits, no customers, nothing. Why? The reason is the customer pain has been well established, and this company has a product that addresses that pain. And therefore, the probability that this company is going to fail due to insufficient demand is dramatically reduced. Example, let's say we can see the example in real life, in real time, every day in the last 18 months. What was for the companies that were developing COVID-19 vaccines, what was the demand forecast? Meaning when we tried to estimate what percentage of the market was going to buy this product, It's very, very high. And we do that with a very high degree of certainty. The demand uncertainty that usually accompanies new products was dramatically reduced in this case. Now, there's some complication due to vaccine hesitancy, but let's say taking out people with vaccine hesitancy. So let's say what percentage of the population who is interested to buy this product will do it when it reaches the market? It's approaching 100%. So demand uncertainty has been reduced or eliminated because why? Because the product is solving a painful problem for customers. So this innovation value proposition, meaning you have an innovative product that solves a painful problem for customers, this is the absolute foundation of your successful startup. You need to make sure that this part of your business plan and your pitch deck is rock solid, because the innovation and value proposition, or sometimes you hear this described as problem solution. I like to call it innovation value proposition because I think it's more specific than problem solution, and it helps to highlight some of the factors that make a successful problem solution. But if this is strong, then the rest of your business plan can also be strong. If this is weak, the rest of your business plan is always going to be weak. Because why? Innovation and value proposition are the foundation of your successful plan. It's like you're building a house. Innovation, value proposition are the foundation of your house. If your house has a weak foundation, whatever else you build on top of that is going to be weak, because the foundation is always going to be shifting. If you have a strong foundation, then what you build on top of it has the potential to be strong. So first, innovative product and solving a painful problem for customers. What's the next thing that we need to look at? The next thing we need to look at is, who are those customers? So we want to know, who are the customers? How big is the market for this product? And how fast is it growing? Why is that so important? Okay, we have an innovative problem that solves a painful problem for customers, but what if the number of those customers or the size of the market for that innovative problem is too small? If it's too small, then we're going to fail. The company is going to fail anyway. Because why? How big does our market have to be for us to be a successful startup? If we work backwards from the firm value that we're trying to achieve, if we work backwards from $100 million firm value, so let's say we're targeting to achieve $100 million firm value by 5 years from now. That means that 5 years from now, how big does our market need to be? Obviously, our market needs to be bigger than 100 million, because if the total market size for our product is 100 million, we will never achieve at that point. So let's say 5 years from now, total market size is 100 million. How could our firm be valued at 100 million? That's 100% of the market. So the total market size for our product should be a multiple of our firm value. And I would say at least 5 to 10 times our market, 5 to 10 times our targeted firm value to make the market size believable. So if we go with let's say 10 times, then that means our market size 5 years from now needs to be at least $1 billion. So, and I think that's not far from investor thinking. We want to make sure that by the time the company reaches scale and is getting to the point where we're interested to exit, that the market will be of sufficient size to support our scalability targets. Now, that raises a question. We are thinking about having a significant size market 5 to 10 years from now. So there's two ways to get there. One is to enter a market that's already big and that will grow slowly over the next 5 to 10 years. The second option is a market that's currently small, but it's growing quickly. So we want a currently large, slow growth market or small, fast growing market. I don't include large, fast growing market because there's very few large, fast growing markets. Vast majority of large markets are going to grow slowly. So which is more interesting, applicable for a startup? Is it a market that is large and slow growing or small and fast growing? My answer is small and fast growing. Why? Let's say there's two ways to get to $1 billion market over 5 years. Let's say the first way is my market is currently, let's say my market's already $1 billion and it's growing at 1% a year. So I'm actually guaranteed that that market will be $1 billion 5 years from now, because I mean, assuming the forecast is the market's going to continue to grow 1% a year for 5 years. So that seems like a safe bet. Second market is currently 100 million, but it's doubling in size every year. So year 2, it's going to be 200 million. Year 3, it'll be 400. Year 4, it'll be 800. And year 5, it'll be 1.6 billion. So which market is more attractive? And let's change the first market to say it's already 1.6 billion. So it'll be a little more than 1.6 billion 5 years from now. So which market do we want? The one that's guaranteed to be, more than 1.6 billion because it's already achieved that currently, but it's only growing at 1%, or the $100 million market that's doubling every year? Why do we want the 100 million market that's doubling every year? Because market growth is actually much more important for startups than current size. Remember, the key size that we're looking at is size 5 years from now. So we would much rather target a market that's going to reach that through exponential growth over the next 5 years than the market that's already there. If you think about that in terms of our market entry curve, where we looked at the market that's reached the inflection point and is growing exponentially versus a market that's growing slowly. If the market's growing slowly, it's already at the top of that curve. It's already large, but it's at the top of the curve, so it's too late. If the market's growing rapidly, that means it's at the exponential growth curve, which part of the curve, which is exactly where we want to be. Now, why is that so valuable for a startup? Why is that an attractive market for a startup? A market that's growing quickly rather than a market that's growing slowly. To understand that, we have to think about looking one level down and understanding what is driving growth of a market. Growth of a market means new customers, as the net new customers. So as the market grows, that means it adds net new customers. In a market that's growing, let's say a market that's 1.6 billion today. Who are the players in that market? Now, we can imagine different market structures, but no matter which of those structures is driving that current growth, it's not going to be attractive for us as a startup. Why? Let's think of a couple of different structures. So one structure is there are 3 big players that have 500 million, around 500 million market share. So adding up to around 1.5 or 1.6 billion. So how are those, what are the key competitive strategies being used by those players. If let's say I'm a company with 500 million in revenue in a market that's growing 1% a year. Now, what's my target for growing my revenue every year? It's not 1%. Companies that are growing at 1% are not going to achieve attractive valuations. Companies need to grow. In order to be successful, companies need to grow their revenue 5, 10, 10, at least 5 to 10% a year. And that's actually quite slow growth. So they probably would like to grow 10 to 20% a year. But how am I going to do that in a market that is itself only growing 1% a year? I'm going to have to do that by taking share away from one of the two other competitors. So if you imagine the market dynamic in this market, 3 players, the market's growing 1% a year. They all want to grow 10% a year. So their whole strategy is, competitive strategy is what? Hold on to our share and at the same time steal share from competitors. So you're going to see a lot of vicious competition in this market. This is what we call a red ocean market. The competitive waters of this market are going to be red with blood of competition. Enter your startup. So your tiny little startup enters this red ocean market. It's dominated by 3 killer whales and you're a tiny minnow. You're going to be eaten so fast, you're not going to know what hit you. There's no way for a startup, or very difficult for a startup to compete in a market like that, because you're going to have to steal share from customers from existing players, and you're going to have to capture way more of the new customers than they are, and you're going to have to steal share from them, and you're going to have to do that with extremely limited resources. It's not going to happen. You're going to get crushed like a bug. Imagine the same $1.6 billion market. There's 100 players in that market, and each player has 1.6 million in revenue. Again, 1,000 players in that market, or 100 players in that market with 16 million in revenue each. Again, now you're the 101st player in that market. How are you going to compete? Impossible. So, because again, you're going to have to compete by stealing share from the other 100 players. But let's look at another market, $100 million market that's doubling every year. This means that market is adding 100 million in the first year, new revenue, and 200 million in the second year, meaning it's adding a lot of new customers. So you, the startup, can now fuel your growth by just capturing your reasonable share of the new customers entering the market. You don't have to steal them away from existing players. You don't have to be subject to that competitive strategy. And it's much easier to capture customers who are new to the market than to take customers away from competitors, because you don't have to deal with barriers to entry or brand loyalty or customer loyalty when you try to capture new customers. So a fast-growing market is the right market for your startup. And if you're looking at, if you're thinking about your especially early competitive strategy, the overall growth of the overall market is much less important than the growth of your sector. So for example, if you look at the food and beverage, the food and beverage sector is not growing very fast, but the alternative protein segment of food and beverage is growing very fast. So fast growing market segment is what you want in identifying the right market for your startup. Next thing that we want to look at is, okay, so you have an innovative product, it solves a painful problem for customers in a fast growing market. The next question that you're going to need to answer is, how are you going to enter that market, get your product into the hands of customers, inform customers about your value proposition, and ultimately sell your product profitably in this market. So that's your marketing strategy. So you need to think about your entry segment. The first and most important strategic decision that your company is going to make at the early stage is choosing the right entry segment. If you choose the right entry segment, now you're going to have a real chance of success. If you choose the wrong entry segment, in many cases, you're going to die before you have a chance to pivot to a new segment because startups have very limited resources. And if too much of those resources are expended on the wrong entry segment, it's very difficult to recover. So think carefully about your entry segment and make sure that your entry segment is well-defined. A lot of startup plans suffer from ill-defined entry segment or poorly defined entry segment, where they look at segment the market in a way that is not meaningful for their product. So I would think about the right entry segment is the one where the customers have a strong need for your product and have the willingness and ability to pay for that product, and you have a differentiated solution that will be defensible when others enter. Then you also need to make sure that in the long run, you can sell your product profitably to that market. Now, it's often not that important for you to be profitable quickly in your market. And a lot of successful startups are not profitable in the early years. Why is that? Because our fundamental growth strategy is fast growth. And fast growth, for most companies, means fast revenue growth because we're acquiring new customers. Acquiring new customers is expensive and difficult to do profitably in the early stage of startup development. So most of the time, we'll find that in the first or second or sometimes even third year, startups who are focusing on this high growth strategy will not be profitable or will be barely profitable. And this is not a bad thing. This is actually, if it's part of the growth strategy, this is actually a good thing. So, but in the long run, everybody has to be profitable. We can't be losing money forever because losing money forever means we're going to die. So one of the most common problems that I see in early stage startup business plans is their cost of customer acquisition exceeds their customer lifetime value. So we call this CAC versus CLV. Make sure that you are clear on your customer acquisition cost and your customer lifetime value. Customer lifetime value means the profit that you will derive from each customer. Customer acquisition cost is obviously how much it costs you to acquire that customer. In the long run, we must have customer lifetime value that exceeds customer acquisition cost in order to be ultimately profitable and successful. Once again, in the early days, this equation is often reversed, and we will be losing money on each customer that we acquire. That's okay as long as it's part of a longer term strategy to flip that equation into the right relationship as the company grows. Next thing we need to think about in our key elements for success is sustainable competitive advantage. Once again, I'll just remind, I will be covering this in greater detail in a later session, but I will introduce this concept now as part of overall elements for success, so you can be thinking about it as you develop your business plan and pitch decks and later I'll fill in a lot more detail. But what does this mean? So we have an innovative product, solves a painful problem for customers in a fast-growing market. We have an effective entry strategy in that market. We have a market expansion strategy. We understand how to sell the product profitably in the long run, and we're working on doing that. But what can go wrong? What can go wrong at this point is competitors will enter. So if we satisfy these first 4 criteria, this is going to get noticed in the market. When new innovative products launch in a market, solving painful problems and attracting fast-growing market segments, competitors notice this. What type of competitors? 2 types, the other startups and established players. And not only do they notice, it's not like they just notice and observe. They notice and they react. How do they react? They react by launching competitor products. And startups who are fast followers may launch products that leapfrog yours in terms of development, meaning they might invest in the next generation of the technology to even leapfrog you. Large players can move in with tremendous amounts of money, much better brand recognition, huge resources compared to your startup, other products that they can use so that they can have very different unit economics. So how are you going to beat the competition? If you can't beat the competition, it's not an interesting investment, because then I should invest not in your company, but in the competitor that's going to beat you. So how do you sustain your competitive advantage as a startup in a new market? 2 ways. One is through intellectual property, so, proprietary intellectual property, and 2 is competitive strategies. And your proprietary intellectual property and your competitive strategies together must create barriers to entry for followers. If you can do that, so if you can create barriers to entry for followers with your intellectual property strategy and your competitive strategies that result in entry barriers, then you have a chance to succeed. If you don't, then somebody else is going to reap all the benefits of the first 4 elements for success that we already discussed. And once again, I'll be coming back to that in greater detail in a later session, because this is critically important. Next thing that we need to think about in key elements for success is the business model and financial plan. Business model means how are you going to make money? And financial plan means how are you going to finance the growth of the business, and what is the company going to look like as a financial investment, not as a product market fit success story, which is what we've been discussing so far. So in the first 5 items on our key elements for success list, we have made a strong case that this company can achieve product market fit. And that's a good thing. And that's definitely step 1 in a successful startup. But achieving product market fit is not the end result, the end goal. It's an intermediate goal toward the ultimate goal, which is generate required return for investors. So the financial plan in our company, in our business plan, will demonstrate that this startup, executing the strategy that we have discussed here, does have the potential to generate the investors' required return. And remember, the investors' required return is more than 20x. And in fact, I'm going to use a number 30x. And our financial plan is going to make the case to investors that we can achieve that for them. Okay, and our last key element for success is team. And the first 6 elements for success that we've talked about. They're in some way in order, but this last element for success is different. What do I mean? This last element for success is a binary. Strong team or weak team. So A team is the strong team and B team is a weak team. And after we go over this list, I like to ask people to think about, what do you think what would you say, given what we talked about so far, are the 3 most important elements in our list? And is it innovation, value proposition, and sustainable competitive advantage, or is it some other combination? And my answer to that question is the 3 most important elements for success for a startup are team, number 1, and then team number 2, and then team number 3. Team, team, and team. Why? Because product market fit and financial plans don't create successful companies. Teams create successful companies. Teams create product market fit. Teams create and execute financial plans. So if you have a strong team, A team, you will have a great chance to succeed. Meaning an A team can succeed almost no matter what. A B team or a weak team will screw up the best idea in the world. So if you think about my phrasing, the 3 most important factors in a successful startup are team, team, and team. It probably reminds you of another 3 most important factors in successful investment, which is location, location, location in real estate. So you often hear people say 3 most important factors in a successful real estate investment are location, location, location. I just said 3 most important factors in successful startup investment are team, team, and team, which brings up the comparison between the 2. How is a startup team like location in real estate? Why is it that location in real estate is so important in successful investment? Is the location is the only thing about property that cannot be changed. The location is fixed. So wherever your property is located, that's it. It's not going to move. So if the location is good, then the property investment can be good. If location is bad, it's very difficult to recover from that. And you can do anything else you want to the property, change it in any way, but you can't change the location or the quality of the location. Now, that's similar for startup teams. We can change everything about product market fit. So all of the 6 factors we discussed previously, we can change, and we can change over and over, but we can't change the team, at least not now. Ultimately, we may change the team, and teams do change at startups over time. But we're investing in the team today. We're investing in the current team. So we don't want to need to change that team. I always say, if we need to change the team, forget it, because we're investing in that team. So if you are building your team right now, make sure it's an A team. If you currently have a team, make sure there are only players in that team that make it an A team. And one point I like to bring up about team also is, you notice a team is the most important factor in investment, and a team means minimum of 2 people. So investors, VCs don't invest in single person startup ideas, meaning there's only 1 person on the team. Actually, I consider it's a contradiction in terms to say 1 person on the team, because 1 person cannot be a team. You need to have at least 2 people. When entrepreneurs come in to pitch without a team, we call them one-man band. They're like a one-man band. You can't have a band, meaning musical band, with 1 person. So strong team makes successful startup. Okay, so those are my key elements for success. And that's the last slide that I want to cover today. I want to go now I'm going to go to question and answer. So I'll stop sharing my screen. Okay, and Now, I'll start with questions in the chat, but since we're on Zoom, you can also ask questions out loud. So don't be shy. Okay, I'll go to my chat window first.
Oh, actually, we will have a one Vietnamese questions. So what would be the percentage expected of risk and returns for ICT? Is it 30, 70, or 50, 50? It's the first question.
Oh, so say again?
The percentage of risk and returns. I think the question is about the failure rate in the ICT sectors. Is it 30%, 70%, or 50-50?
For failure rate.
Yeah, correct.
Failure rate for startups in ICT sector. Correct? Yeah, so there's no difference in failure rate by sector. So the failure rates that I show are for multiple sectors. I wouldn't say that I wouldn't say that, or I don't believe that if we look at different sectors as a whole, in VC investment success or failure rate, it's going to be different from the distribution that I showed. That distribution, it's including tens of thousands of VC investments in every VC invested sector. So yeah, I wouldn't expect any meaningful difference in success or failure rates by sector.
Thank you.
Okay. Okay, so I'll go to the next question. Let's see. The next question is, can you elaborate a little more on the 3% concept and how important it is to the scientists who spend most of their time in laboratories with little information on market growth and direction? Based on your experience with Southeast Asia life sciences sector, can we achieve success in developing spin-off companies without fundamental backbone research institutes such as in North America and Europe? So I think there's two questions there. One is about the 3% success rate concept, and how should I interpret that as a scientist working in a laboratory? And then two is about the Southeast Asia experience with spinoffs, and can we do spinoff without fundamental backbone research institute? So for the first question, so just one point I want to make about the 3%. Remember, the overall success rate for startup is close to 25%, meaning 25% of startups will deliver at least one time the return, meaning will deliver back at least the amount that was invested or more. So don't be too pessimistic about the success rate. The 3% success rate is of startups that deliver the required return. 1x is below required, but it's still not fail. Okay, so, but I do want everybody in class, I want you to target this 3%. So you should be in at least aspiring to deliver the required return. Now, if I'm a scientist in a laboratory and I'm doing research that's not focused on market need, then I'm going to have a big problem being a successful entrepreneur. So we work with many scientists and researcher entrepreneurs. We've been working with scientists and researcher entrepreneurs in Singapore for more than 10 years, especially A-Star Research Institute scientists, scientists and researchers from local universities in Singapore. And also we've been doing in Thailand for the last 5 years. So working with researcher and scientist entrepreneurs who are developing research in their labs that has commercial application. So if you're a scientist or a researcher who's interested in entrepreneurship, you should be, ideal case, you're thinking early in the research process about solving a painful customer problem with your research. If you are somebody who's already reached a certain stage in your research that you're ready to, you want to pursue entrepreneurial career, but you didn't necessarily think about customer pain or solving a painful problem early in the research process, that's still okay. But now you have to think about how to apply this research to customer pain. Now, so that's going to require significant mindset change for you, which good news is we're going to be focusing on that mindset change in the program. But one mistake I see a lot of researchers make, they develop some really cool IP or research, and now they want to become an entrepreneur. So instead of really thinking about what is the best market opportunity for them to pursue, they just pick the first one. So if somebody contacts, some company calls them up and says, we heard about your research, we want to we want to launch this in our market, and they just jump at that because they think it's easy opportunity. But I don't think that in my experience, that is not the way to create a successful startup. You have you have research finding that can be the basis of a scalable product. So innovative scalable product. Now you need to get to work doing the market identification and analysis. So it's okay if you've been spending most of the time in laboratory so far, but if you want to commercialize a product now you're going to have to get really familiarize yourself with the market opportunities and the application for your product. And the question about, can we develop spin-off company without fundamental backbone research institute? I mean, I'm not clear on this question because I think a spin-off company is typically going to come from a research institute or a university or a company. It has to spin off from somewhere. So I think not really understanding the second half of that question, but definitely research, a spinoff that is based on intellectual property coming out of a research institute or university is going to have, I think, a greater chance of success than a spinoff company, without intellectual property. I'm not even really sure what's going to be spinning off if the company doesn't have research, that's coming from a research institute or a university, or even I guess a commercial company. If it's not spinning off with something, it won't be a spinoff. So yeah, okay. And then next question, how do we determine market size growth rate for a specific sector? So yeah, market size and growth rate for a specific sector is a pretty complex task. So we have a very well respected and well understood method of doing this. Usually what we do is we do top down and bottom up market size. We do top down market size by estimating the demand for the product. And we do this through a combination of primary, secondary market research. And we will have to make a lot of assumptions in both top down and bottom up market sizing. We have we will be covering this in more detail in a later session. And we also have several video courses on this and articles that you can read. But basically, we start with figuring out what's the total addressable market based on primary market research. Then we, as part of our strategy, we select the target market within the total addressable market. We estimate how big the target is as a percentage of total addressable market. Then we pick our entry segment within the target market. We estimate what percentage the entry segment is of the target market. Then we estimate what share of the market will we be able to acquire in the first year? That gives us our top-down revenue estimate. Then we do bottom-up. So bottom-up, we start with our business model, specifically our revenue model. We define our revenue streams, and then we do an estimate of the amount of revenue contributed by each of those streams in the first year. At this point, we'll have two estimates of our market size. One is the top-down, the other is the bottom-up. The bottom-up estimate is going to be a function of our analysis of our ability to supply demand in the market. So if you think about it, the top-down and bottom-up estimates should be the same, because one is estimating demand, two is estimating our ability to supply that demand, and presumably we should be able to supply 100% of the demand that we're able to capture. But when we first do this analysis, we're going to get two different results. Top-down and bottom-up are going to be different. Then the next step is iterate. So we're going to take a look at our top-down and bottom-up estimate and see which are our weakest assumptions that are driving the discrepancy between the two estimates. And then we're going to adjust those assumptions, and then we're going to iterate. So we adjust the assumptions and then iterate, and then we do that until we achieve a convergent result. So we get a top-down estimate and a bottom-up estimate that are the same, and then we'll use that as our single market size estimate going forward. To estimate the growth rates for specific sectors, we usually look at the industry research. So most sectors, there will be plenty of secondary research that shows the historical and forecasted growth rates for our sector. If our sector is too new, it doesn't have historical growth rate, and there's no or limited analyst coverage for forecasts, we can look at similar sectors. Or if there's not even similar sectors, we can look at a representative sector in another industry that looks like it should have a growth rate similar to ours. So typically growth rates will be estimated through secondary market research. Okay, so next question is how to evaluate the value of an invention. So as an investor or startup, we don't usually spend time evaluating the value of an invention, because value of invention is important if you're licensing the invention. It's not important if you're doing a startup company or a spin-off company, because why? What's important if you're doing a startup or spin-off company is the value of the company. The invention will contribute to the value. And we have several well-established methods of valuing startup companies, which we're going to learn about later in the course. Once we understand that we're focusing on valuing the company, then we realize we don't need to value the invention separately. Value the invention separately, this is a job for the technology transfer office, not for a startup company or an investor. So the value of the invention will be embedded in the value of the company. We don't need to do separately. Valuing the company, on the other hand, it is very complex. It takes a lot of time. And we're going to learn about company valuation methods in great detail later in the course. Okay, can we have more example on CAC versus CLV calculation, please? Okay, so more detail on example on your CAC versus CLV calculation. Okay, so let's say that our business model is subscription based. So we're selling a subscription-based product. And then let's say our customer acquisition strategy is all online. we're acquiring customers through social media. And to make it easy, let's say we're acquiring 100% of our customers through Facebook marketing. And then we're selling customers monthly subscriptions. So now we want to calculate our CAC versus CLV. So our CAC is going to be, in this case, it's going to be very easy to calculate, because we're going to figure out how much money do we need to spend on Facebook advertising to acquire one customer. And how we're going to do that is we're going to look at our sales funnel. Let's say we need to spend a certain amount of money to reach 100,000 people on Facebook. And of the 100,000 that we reach, then, okay, let's say we have to spend $100 to reach 100,000 people. Let's say out of 100,000 people that we reach, then let's say 10% of those customers click. So we spent $100 to get 10 clicks. So the cost per, let's say 10% of the, let's make it easier. Let's say we spend $1,000 to reach 100,000 customers, and then 10% of those customers click. So then we get 1,000 clicks for $1,000. So we spent $1 per click. And then let's say that out of the 1,000 clicks that we get, let's say 10% of those clicks actually become paying customers. So now we get 100 customers. So we spend $1,000 to get 100 customers. So our customer acquisition cost was 10 cents per customer. Now, which is actually very low. So then let's say that we sell this subscription. Let's say we sell the monthly subscription for $1 to make it easy. And let's say the average customer stays for, so let's just say 1 month to make it easy to calculate. So now we make $1 per customer, and we spend 10 cents to get that customer. So our customer acquisition cost was 10 cents, and our customer lifetime value was $1. So our customer lifetime value is 10 times our customer acquisition cost, which is great. So that's how we calculate customer acquisition cost versus customer lifetime value. Now, actually, that's generally how we would do it. If we want to do more precisely, we're going to have to figure out of that, the $1 that we earn from the customer in subscription, how much of that is profit? So this was just our revenue. So we're going to want to look at what was the actual profit on that. And that's going to be our real customer lifetime value, not the revenue. Also, we're going to want to look at our customer, assuming customer is real life going to stay for more than 1 month. So then we have to add up the profit for all those months. And we are going to have more detailed example on this later in the course. Okay, next question. Please give more detail in your slides so it helps us follow easily. Yeah, so I have a lot more detailed slides, which we're going to share, which we'll share after this lesson, and we can share the more detailed slides before the next lesson. We also have all the slides and all the lectures are available online with a lot more detail. So, since we only have only 3 hours together per session, so we want to cover a lot of topics, there's a very limited amount of detail that we can discuss, that we can cover in the online, in our live session. But I have, we have many hours of detailed, many hours of video available online, and also detailed articles and explanation of all the topics that I'm covering in our online courses, and also all the detailed slides. So, but we'll share more detailed slide with you after this session, and you'll be able to refer to those prior to future session. Okay, and Okay, next question. It said, it is difficult for a startup to set up business model and financial model. May you advise startup, spin-off, how to solve it at the beginning, ask consultant or else? Yeah, this is a really another very good question. It is definitely is difficult for startup to do business model and financial plan. Now that's something that we're going to cover in the course, try to help you to get started on that. Should you hire consultant? I would say not a good idea to hire consultant to do this for you. I believe that the startup, including startup spinoff, somebody on the team should take responsibility for developing the business model and the financial model. The business model and financial model are key to success of your company. And I don't think this is something that you can outsource to consultants. You could use consultants to help you develop, but you shouldn't outsource the development of your business model and your financial model to consultants. And you shouldn't expect, another mistake I see a lot of startups do is spinoffs. They hire an accountant. They think their accountant is going to do this. Accountants don't develop business model and financial models for you. Accountants create your financial statements based on your real transactions. And even if you could get your accountant to develop a model for you, it's not going to be your model. So you need to, if you want to be a successful startup, you need to own your business model and you need to own your financial model. And I understand that for a lot of science or researcher or technologist driven startups, that's going to require some new learning, but that's well worth it. You're going to, you do want to do this new learning at this stage, whether you believe or not. Trust me. Okay, if you are creating a startup company, you're going to be operating in two markets. You're going to be operating in your product market and the financial market. So you need to be able to understand both markets. You can't just understand one market and hope to be successful. So, imagine the reverse is true. Let's say some entrepreneur is really good at business model and financial plan. Do you think they can outsource the research, and development to a consultant and make a successful startup? Impossible, right? Because startup is two halves. One half is about the product, the other half is about the financial. So you have to own both halves as a successful entrepreneur. And yeah, I know it seems daunting, but this is why I mentioned at the beginning, if you're already like PhD in some, very technical research area, and learning how to do a financial model, it should be easy for you. I mean, you can do in a couple of weeks. I mean, at least you can get a working knowledge in a couple of weeks, and you can be good at this in a couple of months. So somebody on the team needs to do that. If it's not the CEO, then you pick somebody else on the team to become the CFO, and they're going to learn about this. Okay, next question was, what is my personal opinion on the ag sector in Southeast Asia regarding scalability, innovation potential, and future market size? So I think ag here means ag tech. Actually, I'm very personally, ag tech. I'm very personally bullish on food tech and ag tech. Actually, we're working on several new funds right now, and some of the most important focus areas for those funds are food tech and agri-tech. So I think food tech and agri-tech are very exciting market segments, not just in Southeast Asia, but in the whole world. But I believe that it's especially interesting for Southeast Asia, because why? Southeast Asia is already one of the leading regions in the world in food. if you think about where does food come from, a lot of food from the further world comes from Southeast Asia, and we have very well-developed industry and research in food tech and agri-tech. So for example, in Thailand, if you look at the universities there, there's an incredible amount of innovative research in food and agri-tech. I bet in Vietnam, the same. I think there are lots of universities in Vietnam that are doing incredible research in food and agri-tech. And food, the good thing about food is everybody in the world needs food, and that's not going to get less. People are not going to eat less. There are not going to be fewer people. So this market is going to continue to grow. So I think definitely I'm very bullish on food and agri-tech sector, and especially in Southeast Asia and particularly in Vietnam. Okay, next question. Should government invest venture capital to start up? So I think that government is okay, whether government should or not, it's a question for government, but I can say that I strongly encourage government to support venture capital in the ecosystem, because if we look at countries that have thriving enterprise ecosystems, they all have significant support from government for startups and venture capital. Singapore, right here in Southeast Asia, I believe Singapore is the market leader in startup and venture capital, and government has been a huge player in this space since I got to Singapore in 2000. In the US, government is a big player in venture capital and startups. In Israel, government is a big player in startup and venture capital. In China, government is a big player in startup and venture capital. So if we look at the most successful startup and venture capital ecosystems around the world, government is a big player. Now, I think how should government invest? I think is a very complicated question. I don't advise government to make direct investment in startup using venture capital fund. I think the most successful model of government involvement in venture capital is public-private partnerships. So where government invests in venture capital funds or incubators or accelerators, and then the private sector does investment with government support, because a high degree of expertise and market knowledge is required to be successful in venture capital, which usually the private sector is much further ahead and has much deeper resources than government. So I think definitely government should be a key player. I think the most effective structure is public-private partnerships. Next question. In Vietnam, there are a lot of the current policies to support business startup, but most of them are still not successful. What is the big problem is that they do not support exactly what business need. And based on being an investor, what would you invest in a spin-off company? So yeah, I think it takes a while for government support to generate successful startups. If you look at, and actually in general, it takes a while to grow a successful ecosystem. If we use Singapore as an example, so Singapore government started supporting startups in 1999 and didn't really achieve any real success until 2010. So it took Singapore government more than 10 years to even start generating success, and the real success came about even 5 years later. So I would say, experience in Singapore, it's a very long-term game. It took Singapore at least 10 to 15 years. I think in Thailand, government started really investing in startups about 5 or 6 years ago, and we're still just seeing results. So I think in Vietnam, government also has been very active in investing and supporting startups, but it takes time to be successful. big problem not supporting exactly what business need. And this is where I think, if that's the problem that we're seeing, then this may be due to some nature of some of the problem, for some of the programs. This is why I think public-private partnerships are usually a lot more successful than government direct investment into startups, because the private sector will know a lot more what startups need than will government agencies. So I think I agree that if we're seeing this type of problem, then it's probably the result of direct investment by government rather than public-private partnership. Or if it's public-private partnership already, then choosing the wrong partner, because it's really important to get the right partner if government programs are going to succeed. And based on being an investor, what would you invest in? Spin-off company. Definitely, we have invested in spin-off companies before. So we have invested in spin-off companies in Singapore and in Thailand, and definitely interested to invest in spin-off companies in Vietnam. So in terms of what we would invest, or how do we decide how to invest, we use the exact same criteria that I talk about in the key elements for success when we evaluate spin-off companies. So the innovative products, solving painful problem for customers, in fast-growing market, et cetera, et cetera. Okay. So next question was more like a comment, which is very exciting lecture with a lot of helpful information. Thank you, Douglas, Kim, and the organizer team. And our pleasure. And remember, this is just the beginning. So we're going to be having a lot of time together over the next few months, and looking forward to going over more topic and answering more of your questions. And then next question, in the case I want to establish special innovation zone where allow all startup to apply regulating sandbox, and can you give some example? Yeah, I think this is a great question, but I think it's a really good idea to have this type of special innovation zone. But I think the answer to this question is going to be, take up a lot of time. So unfortunately, we reached the end of today's session now, and I know everybody's probably hungry and wants to get to lunch. So it's 12:34. So I'll hold off on answering that question. What I would like to do is, for this question and any other questions that you might have, you can post these questions online, and I'll answer the questions online before our next session, and then we can discuss those later in the course. If you don't have the information about where to put the online questions, we will send you after this lesson. So make sure that we have your email address or contact information, and we'll provide you with the channel for the online posting and answering of questions in between sessions. So with that, I'm going to end this morning session and say, again, really excited to work with you in this program, and hopefully we're going to create lots of help to create lots of successful startups coming out of this program. Don't hesitate to add me on social media. I put the social media information in my early slide. I'm happy to see you there and also discuss more question and topic that you might have there. And look forward to seeing you in our next session and create successful startup together. So thanks everybody for your kind attention and question, and looking forward to seeing you again soon.
Thank you.
Thank you.
Thank
Okay.
you. Yeah.
Okay, thanks everybody. See you again.